break and properly.
Hello, everyone, and thank you for joining us for our April member webinar. We have Alicia Landi here. She's going to be going over different types of healthcare for us, especially for small business, which I know most of us are. Don't forget that we have West coming up. It's going to be May 17th through 19th. And then one last little thing of housekeeping, April 29th is going to be your last time to sign up for any of our optional events. April 29th for our Clearwater kayaking as well as our golf event. If you'd like to sign up for those, again, April 29th. So with that, welcome Alicia, and I'm going to turn it over to you.
Thank you so much, Taylor. Well, welcome everybody. My name is Alicia Landi with Landi Consulting. I handle group healthcare for employers of all sizes. And a benefits webinar was previously provided. I'm going to kind of add some ideas and what's going on with the market these days, but feel free to reach out for questions. Some of this information changes from time to time, so if any amount of time goes by, you might want to double check any of the facts that I'm sharing today. So I wanted to piggyback off of the California choice conversation that was already given. An employer between 2 and 99 employees enrolling can elect one of these exchanges. We have two options in California, and I'll kind of talk about the differences. There's California Choice, which has been around for 20 plus years, and then Covered California came out after the ACA, Affordable Care Act. And the reason an employer would elect an exchange is because maybe the employer isn't interested in picking the plans, picking the carriers. They want to just leave the option up to the employee to select what's going to work for them and their dependents. An employer can just lock in their budget and let them go from there. Here's our budget. We're going to pay a certain percentage. We're going to pay a certain dollar. And then employees can clearly see what their options are, maybe picking from a PPO versus an HMO and such. Another reason why you'd pick an exchange is because of participation requirements. If you have mainly everyone enrolled in Kaiser and somebody wants a PPO, usually if you were to go to Anthem Direct, they would need about 50 or 60% participation. This would be a way to allow your employees for one person to elect a PPO and everybody else an HMO because it is the most cost efficient. But if you are just doing Kaiser Direct, and maybe there isn't a reason for Cal Choice because you'd have to pay a monthly fee of $30 to $50. So if you can save $360 if you're just doing Kaiser, I always try to keep it simple and obviously cut back on costs. But just to quickly review Cal Choice, you've got about 8 carrier selections for the employees to elect from. Anthem Blue Cross has some pretty competitive PPO and HSA products when it comes to the PPO plans. This is the product you would use if your employee is elected nationally. If they were in other states other than California, this would be the best, the only product for them. If they had dependents, maybe your children are staying on your medical policy until they turn 26, you would also want to elect this plan if they were going to need coverage in other states. And then Cigna Oscar is fairly new to the industry, a couple years now. I have another slide talking about how amazing they are and what they're doing. In California, we'd be using the local network, which is the Oscar Cigna and Hills networks for Cal Choice. We've got HealthNet. They've got some competitive high-end HMO products. Kaiser, people love it or hate it. It's throughout California in certain areas. Sharp is in Southern California. Sutter Health Plus is a carrier that would be in the greater Sacramento using particular Sutter locations, a little bit of the Bay Area. United Healthcare has some PPO plans in there that make sense, and Western Health Advantage, which is greater Sacramento. So an employee could pick the right carrier for them, and that's just a little bit about that. Now, the reason we would look at Covered California over California Choice is if an employer would qualify for the tax credit. This product has the government assisting employers with up to 50% of the employer contribution if they qualify And the way they qualify is they have 25 full-time equivalent employees or less. And the average of employees, what they're making is 56K or less a year. And we used to have to group in the owners, and now we don't have to. So if you do qualify for this tax credit, would be a good reason to enroll in Covered California. I would first have you confirm with your CPA or your tax consultant that you do qualify, because California Choice has been doing it for so long, they're very turnkey and easy. Covered California is extremely choppy and difficult. So give yourself plenty of time. Let's make sure you do qualify for that tax credit. And if you do, there's no admin fees, which is great, but it can take them a while to process paperwork. And sometimes they make a mistake. If they do, it can take quite a while to fix. So that's with us being diligent and following up constantly. It can be pretty choppy. So I don't love that, but if you qualify for that tax credit, let's get you into that program. I also wanted to make note, there's a lot of ahas out there. I'll try to share a few of them with you, whether I'm meeting a new employer or employees. I wanted to make note that there is pediatric dental and vision built into all of these ACA products, and meaning that if you're enrolled as an employee with your children up to age 19, they're going to have built-in unlimited dental and vision in all of the products. And if you go to these carriers direct, you're also going to have the same benefits. But it's great benefits. And sometimes I come out and meet with the employer's employees, and I see that there's a lot of dual coverage, a lot of employees also enrolling their dependents in dental and vision. It can work, and you can certainly have dual coverage, but make sure you know that you're doing it intentionally and that you're getting your best bang for your buck. Because unless you need orthodontia or your children are over 19, or maybe the children aren't enrolled in the medical, I really don't see a lot of reason to have dual coverage. I would say just keep the pediatric dental and vision. They've got a great network to pick from, and you just have to use their providers and have some great benefits. So I wanted to make note of that. Oscar Sigma is fairly new. I love this program. They're coming in pretty competitive compared to the other PPOs in the market. You can enroll if you are between 2 and 99 employees. And just like the California Choice and Covered California, if you're enrolled, say at 89 and your renewal comes back with 130 employees, they're not going to remove you from the plan. You have other options out there, but they're not going to kick you off your benefits. But Oscar Sigma is great because Cigna's been a national platform product for groups over 50. Now they're going down to 25. Oscar was really great at a concierge products down in Southern California. They've now combined, and they're offering a really nice, beautiful, easy to use concierge program. And I think that they're really going to be able to control costs by helping employees have access, get the care that they need, unlimited calls to the doctor at no cost, using their telemedicine benefit, zero cost for the urgent care. They have a platform of 4 wellness providers that are going to help assist navigate your wellness, your fitness, your health, any kind of questions you have. You can speak to your own personalized concierge team. And I just think that their setup is going to do wonders. I think it's going to do great. So if you haven't already taken a look at it, I would. There's 2 networks that they're going to use. You could pick 3 plans from any of the networks. They got the Local Plus, which is going to be about maybe 10 to 12% cheaper than the Access Plus. And so if an employee is fine with using Dignity, Mercy, and Hills positions, then I would go that route because it's going to be cheaper. And if they wanted to use maybe a UC Davis and Stanford and more robust network, Open Access would be the one that they would look at. And then if you're also out of state, the Open Access, or have dependents out of state, that would be the one that you would look at. But great benefits and pretty concierge support. And there's a lot you can do on your app. So some of the ahas that I hear when I speak with employees, this is a spreadsheet that's very easy to do. I do it at open enrollment. I can do it on a one-on-one basis for employees. But when I meet with employees, sometimes they don't have any idea how benefits work. They don't use their benefits. It's going over their head. Here I am reviewing how the program works. This is something that I'll put together and a lot of ahas come up. This is going to be a breakdown. Say an employer is offering 5 plans in this scenario. We've got 5 plans illustrated, and I break it into parts so that you could say what it would look like in an average, in a cost for 12 months to be enrolled in each product. And I always recommend that employees start looking at their own personal trend. What is my personal trend? And let's buy a policy based on my own personal trend, not based on fear and buying up to a gold or platinum. Because honestly, maybe 5 to 10% of our nation should be in a gold and platinum plan. There's ways of offering such great coverage, but keeping our costs low. And there's ways of, keeping our budget the same, but reallocating those funds back to the employee. But I want people to think about health in a 5-year period. An individual should have 1 bad year, 1 good year, and 3 average years. So let's try to get you close as possible to the right product. And the way I communicate it after going through the benefits is I break it out into these 3 parts. You've got your part 1, which is your out-of-pocket costs. This is what you're paying the providers on a regular basis using the benefits that you elected. Part 2 is your fixed premium. I've illustrated it here in an annual fixed cost with employer contribution removed. This is an example of one client where the employee's fixed costs in an annual summary is here. So whether you're using the benefits or a lot or not at all, that stays the same. And then at the end of the year, calculating what it would have looked like to pay your premiums and then to pay your out-of-pocket costs, and what does that look like at the end of the year. So here's an example I've done with a moderately high utilizing employee. They went and had their preventive services, and if you can see across the board in this example, no cost, because there's about 85 age-appropriate preventive services that employees should not have costs for. But then this employee also went to the doctor because they were sick 3 times. They saw 1 specialist, they had a lab work, some x-rays, an MRI, 12 generic prescriptions, and 1 brand name prescription. So at the end of the year, the out-of-pocket costs for this employee would have been about $5,130. And then I put it in with co-payments, or whether the co-insurance applies, how it looks for all 5 plans. You can kind of see what that cost here would have been, and then you add in your premiums. And so in this particular scenario, this employee would have done best in the Silver Kaiser product because they were right in the middle of the road of using their benefits. But you can also kind of gauge the other plans if you're leaning towards another plan, if you're debating between 2, what other options, what would that cost have looked like? And we can help employees either do an estimate, and we're happy to show you, where we had to make estimates, or exact concrete numbers using your explanation of benefits. We don't have a problem putting this together for people, but it's a way for them to understand what it looks like. Now, every plan has an out-of-pocket exposure. So what's the worst case scenario? I'm in and out of the hospital all year long, $10 million in expenses. What am I going to spend at the end of the year should something happen? And this is an eye-opener. So HSA, worst case scenario, is going to be $6,350. That's going to be after my employer already contributes. I pay my premium, which is none, and then I'd be paying the out-of-pocket exposure. So that's the best case scenario of all the plans. But as you can see, these 3 plans are like neck and neck. So really no wrong door. Let's just get you into the plan close as possible for you and your family, so we're not over-insuring you or under-insuring you. And then take a look at right now, an employee might be on the fence. I either go a couple times a year, or I'm going to be planning on a surgery or planning on a baby. I don't know if we're going to do it this year, but I need to make a big decision right now for healthcare because you're locked into these benefits for a 12-month period. In this example, you can see the employer is paying 100% of the premiums. So that's going to be the least expensive benefit. If you're not going very often, this is going to be the best benefit. And if you're going all the time, this is going to be the best benefit. So if you do the math for an employee that's on the fence, they can see that this is probably the best choice for them, unless they're, maybe the silver plan. So happy to do that for people, and maybe talk to you about your own personal scenarios. If you want to reach out to me, I have no problem helping anybody. There are other outlets besides fully insured. I know we're talking to some smaller companies, but there's outlets for smaller companies too. And healthcare is just so expensive that I really encourage everybody to take an hour or two a year just to really understand what your options are, because employers' costs continue to go up. They're spending more than ever on healthcare, but employees are on the hook for more deductible, more out-of-pocket exposure. Their dependent cost is extremely expensive and going up. I really think it's important we do our due diligence for the families that are working hard for us to know that we've exhausted every option. Fully insured products, you've got handcuffs, you're not getting decisions. It's basically the carrier stacking the cards, and they're taking on all the bad consequences and passing on they're keeping all the good consequences and passing on all the bad consequences on an insurance plan. And there's some different kind of financial vehicles that we have to pick from. And I don't want to use the word self-funding because it does scare people and they might have some bad experiences with it, but it's a whole new world and everything has been examined and fixed. I would look at other outlets, and starting at 10 employees, this level funding is more like a fully insured, but you're actually going to be able to pay less taxes, lower overhead. If it's the right program for you, that you're going to be able to receive some unused claims back. Whereas in the fully insured market, they're going to keep any of the claims data, any of the claims funds that they put aside for employees. If it doesn't get used, fully insured carriers just keep that. Level funding is going to be able to give you a portion of that back. And you're going to start receiving data, which is great because we can make really great decisions with any kind of data. More data, the better. And then fully insured, we're not going to get that at all. So I like these products. Level funding will go down to 10 lives. If you have 10 people on a PPO product, it might be a really good fit for you. And the captive that I love goes down to 40 lives. So if you have 40 people in the PPO product, it might be a really good fit, and you're starting to receive raw data and making decisions. But as you get bigger, the more larger your company is, the more options you have. Everything here I will illustrate with controlled risk. You'll know what your worst case scenario is everybody got swine flu. And if it's in par with what you're spending, then it can be a win-win-win. And if you have 100 employees enrolled, it's typically self-funding your dental is the easiest way to start doing self-funding. And it's usually a slam dunk. You're probably going to save at least 15% the first year. Let me just talk a little bit about fully insured products, because as you grow, you might want to start looking at different outlets. Fully insured products, if you have a bad year, you get a rate increase. A good year, rate increase. Average year, rate increase. Keeps going up and up and up and up. And no data. Over here, if you can shift into one of the self-insured products that we talked about, you might have a bad year, you pay a little bit more, but it should level out. You have a good year, maybe you pay a little less, and it averages out throughout the time. And I encourage people to look at healthcare, and more of a 3 to 5 or 10 year strategies rather than just 12 to 12 every year, block and tackle each renewal if possible. What can we do to shift our company and our mindsets into a different direction so that we can have more control and offer more stability? And so I think that there are more ways now than ever to round out our benefits packages where we're not spending more money. We're able to do a lot more for no extra costs, really. And I've got about 5 ideas here to throw out at you to make sure that maybe you're looking at different carrier solutions and options, because carriers are more progressive than ever. Beam has been very exciting. I've been rolling a lot of groups in Beam. They've got really strong contracts, but their perks are really progressive. They're going to offer an electronic toothbrush to everybody that enrolls in a dental policy. So if you're enrolled with 5 kids, everybody gets their own electronic toothbrush if you want. You sign up on the app and they're going to encourage you to brush your teeth 2 minutes in the morning and 2 minutes at night. And you're able to accrue some points to buy your toothpaste and floss. So that's fun for employees. And if you can also work it into your wellness committee ideas, because it also can give you some rate relief as an employer. If you've got a group of A brushers or B brushers or C brushers, they'll give you a little bit of rate relief at renewal, which is fun, but something to think about. And when I say their contracts are strong, I mean is when you say you're coming onto a policy without any previous dental, say you're enrolling in dental for the first time, all the other dental carriers are going to have a waiting period for basic work and major work. Preventive is going to be covered right away, but basic and major could be a 12-month wait or 24-month wait. Beam doesn't do that. They are going to allow you to have all coverage right away. So that makes it comfortable to use your benefits. It's always uncomfortable me as a consultant having to tell someone they have to wait, and employees don't want to hear that. I'm purchasing a dental plan. Why would I have to wait to use my benefits? And the carriers do that to protect themselves from people coming on and just using up their benefits and jumping off. So I understand it, but Beams figured it out to offer that benefit with right away. They also do things like no implant, or they offer implants, no missing tooth clauses. Endo and perio is always built into basic coverage instead of major coverage. And then if you look at the cost of having a $2,000 calendar maximum, it's only pennies more to do a $4,000 calendar maximum. So they've got it priced really well to offer a really big benefit should you need it. So I'm really excited to be working with them. Cypress is also another carrier that's doing some great things. They have a triple platform product, which, the closer we can get to meeting an employee's needs, the better. Beam will also offer a couple benefit programs too. Aetna Sutter is great. It's also a national product using the Aetna network. And then if you can do any Sutter Health facility, it's going to be a lot less expensive. So if an employee is open to Sutter Health, then let's get them in there, save some money in premiums. I love this product itself, but one of the progressive perks that they're adding is an Apple Watch. An Apple Watch, for those that don't already have it, they can purchase it for $49. And then there's an $11 monthly fee that they would pay, but they're going to waive the fee if the employees are meeting their wellness and fitness goals, which is very exciting. So maybe you take a couple-week vacation, maybe you miss a month, you pay that month, you come back and you're motivated to get going again because you're going to have that fee waived if you're meeting your goals, which I think the better engaged employees are and we can work on health, the better. And right now it's for Apple, but the Android's coming this year. A lot of times I speak to employees, obviously, and they always ask about LASIK, and I'm always rolling out vision policies, and there's always a discount attached to vision work, but not specifically a LASIK policy. And there's a few carriers doing it, but Emeritus has one that will go down to 3 employees, and it's where maybe you're accruing tangible dollars. So maybe the first year it's $1,000, and then maybe it grows. So when you need your LASIK surgery, you've accrued a $1,500 or $2,000, and you can use it at any facility, any doctor. So that makes it really easy to use, and you only need to have 3 people enrolled alongside another benefit. Pet insurance is another way to get people back in the door. I know we're always trying to find creative ways to get employees to make a robust benefits program to be the most attractive employer, to retain these employees and get more talent through the door. This is a hot topic. I would say 85% of people are requesting pet insurance, and it makes sense. People, are thinking of their pet furry friends as their family, and they want to make sure they have adequate coverage. There's discount products available and actual insurance products available to them. MetLife has one, 50 plus. True Companion has some. There's a discount program through a SPISA. So I can share more about that, but definitely just add it on. It doesn't have to be another cost to the employer. It can be an employee's cost. Jet Dental is very exciting. It's a benefit to tack on, say, Humana, and there's other carriers that they will work with, but it's basically, say we get a quote from Humana, Humana will include Jet Dental at no additional cost. And what the service provides is they will come on site to any facility or location as long as they have 20 employees and do the dental work of your staff and their dependents. So as long as we get 20 people to show up, they'll come out and do all the dental work. And if you think about the productivity that that brings on a big level, we have people, one person goes out at 2 o'clock, it's a dental appointment, they probably don't come back to the office. It's a way to push people to get those preventive services done. So I think it's a great tool to add on to any kind of program, and it's no extra cost. They can just include it. So I love that. And then one more, United Concordia. We have a United Concordia solution here where if you enroll in dental, and they're going to give you the option of enrolling in this tuition program, which is very exciting. They call it points, but it's actually dollars, it's funds. So for example, I enroll in dental and I'm buying $1,000 calendar year benefit. Say I'm enrolled for 10 years. Every year that I'm enrolled as an employee, I'm going to get points into a bank account every year rolled over. I just have to sign up for the bank account and I have to make sure I log on every year, make sure it's set up. And then they're going to put, I believe it's $2,000 points as an employee into my bank account. I meant to double check that. Sorry. The employer gets dollars, the broker gets dollars, and the employee gets dollars. And it's a nonprofit that they work with that are allocating funds to pay for tuition. So say you're in this plan, dental plan, for 10 years, you've accrued $20,000. This money's in your bank account. Now you can use it to pay for anybody's tuition that is a student going into the 11th grade and they're going to a private college. You can allocate these funds to that student and they don't have to be related to you. So as a broker, I'm also getting funds into a bank account that I can allocate to somebody. I'm looking for somebody moving into the 11th grade going to a private college so I can give them some funds and help them out. And it could be great for anybody, your dependents or anything. So I think that's great. Their rates are very cost efficient. United Concordia is easy to work with. I love them. So I also love this tuition program too. It's pretty exciting. Another way to round out your benefit package, if they're in line with your rates and benefits, then they tack on this additional tuition program at no cost to the employer. You're actually going to be able to make money. So here's a slide. I put some ideas together on maximizing our efforts on healthcare. Doing an employee survey. I meet with a lot of employers and they don't do employee surveys for one reason or another. Maybe they're worried they won't be able to meet some needs. Maybe the employees are going to ask for too much. But I do find we learn so much about what employees want from doing a survey that I gain a lot of information. And a lot of it we can do right away. A lot of it we can meet their needs. We just didn't know. And as an employer, you don't ever want to ask employees, what about your health, anything like that. You definitely don't. But this is a way for us to gauge their interest. And if we're buying a healthcare package for our employees, it's extremely expensive. And if they aren't getting the best utilization out of it, why spend any dollar at all? If they don't like their benefits, why spend any dollar at all? Really, unless you have to. But this is a way for us to, roll out some ideas that could work now. And then if maybe we want to develop a plan for later, maybe we can't do everything now. Maybe we want to know what our plan is for the future. But we also learned that 53% of people don't understand the materials that are being provided to them by their benefit brokers and employers. So this is a way for us to gauge, how do you want us to educate you? How do you want to get the information? And what else, are you looking for? So you can fine tune a benefits program with gaining information from them. And if somebody wants a benefit as an employee survey, I'm happy to share one with them or customize one for them. and everybody learns a different way. So I think there's about 7 different ways we try to communicate to make sure that we have, if it's email, let's do it. If it's one-on-ones, let's whatever it takes to get information to those that are interested in the information. And another idea is when I meet with employers, say an example would be an employer is paying 100% of a benefit program, of a benefit for their employees. If you're not incentivizing employees with an opt-out clause in lieu of benefits clause, for example, they might enroll in your benefits when they have coverage, say through a spouse, or maybe they're 24 and they have coverage through their family. Maybe they have government programs they're enrolled in, but we're not incentivizing them to not elect your benefits. And what happens then is they enroll in your benefits, and they're dual covered, but medical, it does not make sense really to have dual coverage. Maybe 2 dental plans make sense, but it doesn't make sense for medical. You're basically wasting premiums, and the employee is not really receiving that benefit. So if you're paying $350 a month for this employee, they're not receiving $350 a month in benefit. And I gave a little example here of just 3 employees being dual covered. Maybe an employer is paying $350 for 10 years. That's $126,000 that an employer ends up paying just for 3 employees, and your employees are not receiving $126,000 in benefit. So you could say, we'll give you $50 a month or $100 a month, but there's got to be some skin in the game for the employees to receive in order not to enroll in your benefits. And you could always say, we need proof of coverage every year. Let me see a copy of your certificate or your ID card, just to make sure we're getting people covered. We don't want them running around without insurance, but we also don't want to waste premiums. And we could do a lot more with 126 than just leaving it with the carriers. And then being intentional. I talk about this a lot because, healthcare is a 2nd or 3rd, 4th top expense at any given company, and it's extremely expensive for employers, but also for employees. Healthcare has been rising for 20 years, and the ripple effect on this country has been detrimental to employees. It's supposed to be 70% of Americans have $1,000 in savings or less. And if the average deductible is $3,000, this is the #1 reason why families are filing bankruptcy. So I say, take the time. If you're in fully insured and that's your only option, know that, but know if there's other options. And if there's not options now, what can we do in the future to get ourselves there? What kind of adjustments can we make to get ourselves into a program that we're receiving data and that we're receiving our unused claims minimum? And then develop a benefits committee and a wellness committee if you can, because we want to create a culture for employees to want to work at the company. They want to feel loved. They want to feel acknowledged. They want to be seen. And when you put together a wellness committee, there's, it's super easy to pull one person from each department. You don't want to put all that stress on your HR, but if you pull one person from each department and we extract what's already being offered to you in all the carriers and making it available to employees, if I were an employee and my employer is writing the check for my health care and they asked me to fill out this confidential health questionnaire, I would do it. If they asked me to go get my preventive services, I would do it. But I also want to be part of a community that cares. So that's one idea. When safety came out, everybody immediately put together a safety committee. When OSHA started, it was boom, this is our committee. You get hurt, you go here. You get hurt, this is the process. You speak to this person. It was, risk on reward immediately, but benefits and wellness, it's more of a long-term play, working on our cultures and working on productivity. So we can always do better. And then culture does run downhill as well. So it really does start at the top. If you're leadership, management, see if you can be as involved in this as you can. And then I think that's about it. There's a lot of new mental health tools available. I'm probably interviewing different companies daily on what they're able to offer. So if you're interested in looking at that, EAPs could be thrown in very inexpensively. But there's just so much support out there. We want to make sure that we're giving the employees what they need when they need it. And here's my contact information. I'm always expecting candid feedback, but if you do have questions or need any assistance or guidance, I'm happy to help at any level. This is what I love to do. If there's something that stands out in your benefit package, I'm happy to be a second pair of eyes at renewal. Anything that you need, I'm happy to help.
All right. Well, great. Thank you so much, Alicia. I really appreciate you taking the time to speak to our members today. That is her email as well as her phone number. So feel free to grab that and or reach out to me if you do need her contact information. I'm here for that. And thank you, Alicia. I appreciate your time.
Thanks, Taylor. Have a great day.
You too. Bye.
Bye.